have the right patient mix, money comes in. Okay, that's the level setting. Okay, so that's the top line. The bottom line, or the middle line, is expenses. So we have to spend money to make money, which says we have staff, we have services, we have to pay for drugs, all that stuff. And so that's where the expenses part comes in. And at the end of that comes this thing called income. That's money you take to the bank at the end of the day. Net profit is also how that is known. And today's discussion is going to focus on how do I predict that revenue number so that I have good projections to manage expenses against. Okay? In saying that, I want to just be very I want to acknowledge the fact that there are expenses. Where do expenses come from? You all know what a profit and loss statement is, otherwise known as an income statement. You use these things. Okay. High level overview. Gross revenue. We do stuff, people give us money, insurance companies give us money. Cost of medical services, cost of drugs, cost of treatments, cost of supplies, those are variable costs depending on how busy we are, right? Okay, equals net revenue. Then we have to take out administrative. All of you sitting in this room are what is affectionately known as overhead. Welcome, right? So the administrative staff, how much is it? How much is my billing personnel? How much is my front desk staff? How much am I spending on marketing? How much are the doctor entitlements? All of these things come in to the fixed expenses that come out. This is money you're going to spend either way, whether 100 people show up or one person shows up. That's money you're going to be spending. Comes to a nice little accounting terms called EBITDA, earnings before interest, taxes, and depreciation. We doing okay so far? Half a chicken? All right. Okay. Earnings, we take out our fixed and variable costs, minus interest, which is a tax-deductible expense, minus taxes, welcome to America, and they're going up, in case you were wondering. Depreciation and amortization, fun games your accountant is going to play to make it look like you have less money at the end of the year than you do right now. Okay? So we take all of those things, which comes down to the net income column, and this is where I want to just stop for a second and say that a healthy service-based business, which is what all medical practices are, a healthy margin is a 20% margin. Some of you may look at that bottom line and say, how the heck am I going to do that? In fact, most of the businesses that we work on are running somewhere between a 5 to 7% profit margin at net income, net profit margin at the end of the year. And a net profit margin means you are living a net profit margin of 5 to 7 means you're still living paycheck to paycheck, and it's not a sustainable way to run your business. So as we're looking at cash projections, as we're looking at the revenue minus expenses, how do we position ourselves in order to make sure that we are maximizing that net income line, which is the end of the day profit that the doctor is going to take out of his practice, right? So being specific on the top line, we've talked a little bit about all this stuff. This is all the monies that you spend on the expenses, okay? Talking about medical costs, talking about drugs. All of those are things you can control. All of those are things you can budget for. That revenue number becomes the big unknown, and unless you can get that number stable, all of the rest of this is just a fun little game of cutting costs, which isn't going to give you any good end result in the end. Okay? So given today's reimbursement change realities, reimbursements are not going to go up. We know this. That's a fairly well-established fact. Cost containment is going to become and it will continue to become the name of the game. How do we milk the most amount of profit from each dollar? That's not going to change either. Okay? And especially given, if you've all, for those of you who are in the EMR game, you know how much money you've just spent to get one of those. And for those of you who are about to enter the EMR game, you know how much money you're going to need to get one of those. And where is this money supposed to come from if we're going to continue to run a sustainable business and make our profit at the end of the year? We're going to put ourselves out of business if we don't do this right. So we want to be very cautious about that. We have to create a budget. Why? A budget's eye on the prize. A budget says this is the target. Here's how we're going to spend it. I've got a solid revenue number that I can trust, and I've got good expense numbers that are believable, that I can manage and maintain. I've got a good shot at saying, I know where I'm going to be at the end of the year, and therefore we can take action. We can buy that EMR. We can hire that another doctor. We can add that additional staff in order to make sure that we're managing our profits as well as we can. Okay? Why? Because the primary benefit of not planning is that failure comes as a complete surprise, and it's not preceded by worry or depression. Isn't that right? So why should we do any of this, right? None of this is necessary at all. Failure is so much fun. Well, surprises are great at birthdays and Christmas. The rest of the time we want to be a lot more cautious about the way we're running our business. That's the second. Make sense? All right. Everybody's head hurt yet? You all right? Did you catch all that?
I'm right. Yes, I got it.
Okay. Good. All right. So in order to predict your cash flow number, there are 4 pieces of information that you should know absolutely off the top of your head. How many patients do we see in a year? How much income do we bring in 1 year? And how does that flow? You probably know bullet number 1 and bullet number 2. You've probably seen a 2009 year-end statement that said we made $1 million and we saw 1,000 patients. You probably have something like that that's already available to you. The cash flow number is typically where we don't see people having a solid understanding of how this works. And so this is where we'll start to slow down and talk about exactly how you can understand your payment flow. This typically manifests itself in a place called your percentage of claim paid or your collectibles to date, some version of that, depending on what reporting system you use. They're going to call it by different things, but what you want to know is, in essence, how much money do we collect within 30 days? How much money do we collect within 60 days, 90 days, 120, and how much is after that? Bad debt typically follows even further after that, right? And then how is that adjusted seasonally? If you're running an urgent care center in a ski town, it is safe to predict that your business will take an increase during the winter months and will have a decrease during the summer months. Logical, right? So not only do we look at that overall number to say if we saw, if we had made $1 million and we saw 1,000 patients to make that $1 million, you can't say that means we saw the exact same amount of patients month after month after month. Things vary, right? Not many people go to the doctor the week of Christmas. That's a fact, right? So how do we adjust these numbers for seasonality? February is probably, I don't know any of your businesses, well, I know a couple of your businesses, but February is probably one of your lower months. Duh. There's only 28 days. Oh, that makes sense. So how do we adjust this cash flow for seasonality? Okay, so paying attention to these 4 things will put you in a position that you can understand where your cash flow is, you can understand what your cash position is, and as I said, walking out of this meeting, it is my goal that you'll be able to go back to your office and predict how much money you're going to have on Labor Day. Now, where did this model come from? This model was created by myself and the finance department at the University of Denver. We spent a good number of time because I had a problem. And my problem was, so I got, and I run a business. This is my 3rd business, and my business is running businesses. And my problem was, we got these things called balance sheets, okay? We got these things called income statements, otherwise known as profit and loss statements, okay? We got this thing called a cash flow statement, okay? How much money do I have? None of them tell you. They're all, if you piece it all together, the answer's in there somewhere, but cash in the bank is not obvious from any of those statements. So we wanted to pull all of these together and say, all right, cash in the bank, how much money am I going to have? We've tested this model. We've broken it a number of times. We've tested this model over the past 4 years, basically, and we've made adjustments to it. And what we found out is the tagline of this presentation was predicting revenue and cash flow within 5% accuracy. The reason I didn't say 5%, but the reason I said 5% is because 0.002% sounded a little boastful. But that's the reality of what we're getting in managing this model. We're managing our expenses, we're managing our revenues, and using this kind of cash flow prediction model is putting us in a position that we are so specific. That 0.002% is, for the business I run, what we just wound up with for the end of April, and I couldn't be happier.